All right, what is up, traders? What's up, tycoons? Lots to talk about in today's video. We're going to look at the false breakout in XLF, the financials. We're going to take a look at some individual names as well, such as Palantir's got a big head and shoulders right here forming XHB. This is the Homebuilders ETF with a very clear bump and run pattern, breaking below key support level of 77.13 recently. We're also going to take a look at the gold futures. We're going to take a look at TLT and go over the 5-wave count to the downside after we got the break of compression, right? Price action was compressing for this long time in this triangle pattern. And ultimately, we're looking for a 1, 2, 3, 4, 5 down, basically, to take us anywhere from, potentially right here around to the $89 price target. Okay. So it appears we're getting very close to putting in a wave 5 bottom if we already haven't. All right, we're also going to take a look at GDX. This is the gold miners, kind of relevant with that gold chart. Okay, we're going to break down all of these in today's video. So be sure to smash the like button, subscribe to the channel. We're also going to compare the gold versus the US dollar. This is pretty interesting right here. Now, of course, as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the disclaimer here. And we'll go ahead and start looking at Goldman Sachs has recently nudged up their 12-month ahead Brent forecast from $93 to $100 as we now expect modestly sharper inventory draws. And so this is their range right here, basically 80 to 105, and they see it going up to that $100 price level here. Now, this is something that we've been talking about for a while. And when you look at the crude oil futures, it seems like, it's getting a very textbook breakout and retest to potentially continue going higher, right? You can see the trend line, rejection, breakthrough right here most recently, and it seems to appears to be getting, a very clean breakout and retest. And again, that would push it up higher to about 97 and potentially even 105. Energy is something that I've been talking about a while. Right, this is the newsletter right here. And over a month ago, we talked about ExxonMobil. Obviously, this is an energy company. You're even seeing articles coming out these days saying ExxonMobil is about to make all-time highs. I've been talking about ExxonMobil. You can see since this point, all right here, ExxonMobil is at 111. ExxonMobil ran up to about 117, got a nice breakout of the trend line here, heading towards the 119 price target. And if it is able to trade above 119.79, basically 120, we do have some price targets to the upside if it continues the uptrend. One thing I want to point out here is that, we had the clear bearish divergence. It caused a drop in the price of the stock, and we actually broke through that bearish divergence, and we also got a bullish MACD crossover here. This is stuff that we highlighted in the newsletter for you guys when going over some of the trade ideas. We talked about it retesting its bearish divergence on the trend line on the RSI. A breakout could give it the momentum thrust it needs to send the stock shooting to the bullish price targets up above, and we're seeing that currently. Okay, it's not just long positions. Okay, in the newsletter we also go over short ideas. This is SWK right here. This is, in my opinion, a little known stock or little traded stock. This is actually Black & Decker, and we gave the targets, some of the indicators. We had a bearish crossover here. All right, overbought territory combined with the bearish crossover plus a rising wedge, and we're looking for the breakdown. And if you take a look at the stock and what it's been doing, it did exactly that, right? Here's the forecast for the trade idea. Here is the actual performance of the stock coming exactly down here, right to that $85 level, hitting the price targets. So, if you guys want to sign up for this newsletter, so that way you guys can get really good, free, valuable content, as well as these completely free trade ideas straight to your inbox, use the link in the description. Okay, there's many trade ideas. All right, I try to do at least 1 or 2 a week. All right, this was a Tesla trade idea, from the newsletter as well. This one, if you trade options, okay, very, very profitable on the options. We went over the setup here with the abandoned baby and the trend line break. I do want to mention, you can also use the link in the description to check out Ko-Fi. And on Ko-Fi, you guys can directly commission a video. All right. I just started this and actually just got the first commission. All right. You can come on here and request a YouTube video covering any topic of your choice, whether it be a strategy, tutorial, something you have a question about. I'll be happy to make a specific video for you there. You can also request one-on-one sessions, okay, if you guys are interested in a 30-minute or 1 hour personal session. You can book directly through that platform. And if you ever enjoy the free content and would like to leave a tip or donation, there's a buy a coffee button right here where you can make a simple donation of, whatever you like. Let's get back into the content. So in a higher rate environment, the global debt stock rose by $10 trillion to a new record high of $307 trillion in the first half of 2023. So we're looking at the percentage of GDP here in red, and then we're taking a look at the global debt. Okay, and again, setting a new record high in global debt. Right here, what we're seeing, bankruptcy filings have been on the rise since the Fed began raising rates. This vertical line right here symbolizes when the Fed started rising rates, and this top left chart here is bankruptcy filings for companies with at least 10 million in liabilities, and you can see that we've seen a rapid increase. Same thing over here when you're looking at a little bit smaller companies with at least $2 million in liabilities. Again, this is January of 2023, and you can see since the year has started, we've seen a significant uptrend right here, basically in this. And if you were to just basically go from when the Fed started, hiking rates, which is back in March, you can see that that's clearly an uptrend when before it was in a downtrend, and that downtrend completely ended and started a new uptrend. But, we're really seeing a peak, not a peak, but, an elevated trend really since the beginning of January, right? This right here, right, and these numbers look a lot different than the numbers below this level, right? We can see, basically this was our peak here right around 40, in 2022, and 2023 has started, and we're seeing a significant, basically a new trend trading above 40. This is credit spreads. Now, credit spreads are not pricing in a recession at the time, right? And this is something that, a lot of people have been really confused about, how come the market's been going up? All right. I know recently things have started to pull back. But a lot of people have been very confused. And when you take a look at credit spreads, you see the stock market and credit spreads, basically have a relatively same pattern when it comes to performance. And right now we just haven't been seeing credit spreads pricing in a recession. And that's evident, by some of the performance of the stock market too. You can also see that, and some people would say that the market is oblivious, right? When you take a look, risk appetite is as strong as it's been in 18 months. This is the Bloomberg Financial Conditions Index. And so you can see the only time that we really had a significant drop was right here in March of 2023. Okay. And that is when we had the banking crisis, right? So financial conditions tightened right here at this moment and fell sharply. But what happened? The Fed came in and actually stimulated and, put in more stimulus, and financial conditions have continued to rise. If you take a look, again, it's the strongest that it's been in 18 months. And, bond yields this year have likely risen due to the market's improved perception of economic growth potential. So to kind of recap things, so credit spreads are not pricing in a recession. Right? Risk appetite is as strong as it's been in 18 months via the financial conditions index, and bond yields are rising, okay, due to the market's improved perception of economic growth potential. So, while the news and there is lots of fear, FUD, fear, uncertainty, and doubt in the market right now, okay, about the, coming recession, the market seems to believe the soft landing narrative. So that's what you have to realize right now. The market, with both the bond market and the stock market, are pricing in a soft landing. Okay. If that narrative changes, all right, it's very possible that you're going to see a sharp drop in the stock market as they have to reevaluate for a hard landing versus a soft landing or no landing. So, again, we talked about how the financial conditions index is showing that, credit spreads is showing that. And here in 2022, the move up in bond yields was accompanied by tightening in financial conditions, which hurt U.S. growth stocks. And what happened is, basically the Fed was raising the Fed fund rate at a very, very extremely fast pace. Okay. And so that caused bond yields to rise. When people look back in history, okay, they're going to either call this, basically the Fed fund rate bear market, okay, basically like the interest rate bear market, or they're going to call it, the inflation bear market, all right, of 2022. And, a large part of that, again, was due to the rising interest rates. Obviously, it caused stocks and bonds to both drop. But what we're seeing is bond yields continuing to rise right now, and it's not because of inflation and expected rate hikes, all right? It's rising because of improved perception of economic growth potential. And again, look at the real GDP growth expectations right now, okay? Absolutely skyrocketing, being ripping to the upside, right? If you wanted to perform some technical analysis on this, right? Which, I mean, not saying that you should be performing technical analysis on the GDP expectations, but, basically was in a downtrend, right? It had a clear downtrend here. And we're seeing this thing skyrocket up here. Now, what's pretty interesting, look at the previous peak right here. What year was this? Well, this was right around 08, 09. And so is that something to be, a cause for concern? Is that maybe expectations for real GDP growth are a little bit too high, and that soft landing narrative is being pumped a little bit too hard, and maybe this is due for a pullback, right? Something to consider. Now, 10-year U.S. Treasury yields are tracking their pattern around the pre-1990 U.S. recessions. U.S. 10-year bond yields are tracking per 1990s average, and if they continue to follow this path, there seems to be limited room for yields to rise meaningfully. Now, who's this important to? Well, this is important to people that are interested in things like TLT at the moment, right? If TLT and you think that basically yields aren't going to be rising meaningfully, right? As this chart suggests, a limited room for yields to rise meaningfully, then perhaps you're interested in TLT, right? Because as yields go up, the bond prices go down. Okay. It's that simple. And so if the yields don't have much more room to the upside, and that's what has a lot of people interested in, bonds and bond funds and bond ETFs such as TLT, because, if they don't rise that much more and they start to flatten out, and then eventually the Fed cut rates, that's going to cause yields to come down. Okay, and as yields come down, the price of the bond is going to go up. And so people would be trading essentially bonds and looking for that price appreciation. A steeply inverted yield curve tends to mean that a rate cut is coming, which would again suggest that this is a good time to buy bonds, right? You can see from Bloomberg here, they have this post, opportunity knocks. If you want to buy a treasury bond, now seems a good time. Well, Zach, can you explain this a little bit more to us? Why is it a good time other than what you just said? Well, let's take a look at the 10-year treasury yield here in black and the Fed funds rate here in blue. And what do we see? We see 10-year treasury yield peaks before we see the pause in the Fed fund rate, okay? And then same thing over here, 10-year treasury yield peaks before we see the pause in the Fed fund rate. Here, it's basically the same exact time, okay? And here is where we are, or here is one of the latest examples, okay? The 10-year treasury yield peaks, all right, starts going down. Then we see the Fed fund rate pauses here. And so that's what people are questioning and wondering right now, okay? And if you think that the Fed is going to be permanently pausing sometime soon, or if you think that they're going to potentially be cutting sometime soon, all right, then, it could be a good time and a good opportunity to get into bonds, all right? Again, this is the yield right here for the Treasury. If this starts to go down, bond prices will typically go up. That's just how bonds work. Okay. If we take a look here, we can see the spread between the S&P 500's dividend yield and 10-year U.S. Treasury yield is back to where it was in October of 2007. And so this is maybe something, again, to be a cause of concern, right? The reason being is because of what happened after that, right? We had the great financial crisis, basically. Okay. So we're seeing lots of warning signs, and the Fed usually doesn't start cutting interest rates, right? The last chart was a visual about yields and them cutting the Fed fund rate. They usually don't do that until something is very bad in the economy. And if something is really bad in the economy, then stocks may have to get repriced and reevaluated, and valuations may come down and stock prices may drop potentially. But if they're cutting the rates, then yields are going to drop and bonds are going to go up. So right now, even if you just want to hedge a portfolio, I think that there's a lot of opportunity in bonds right now. Okay. And there's different instruments and different ways to go about it. But even the yield alone, okay, and just, if you were to hold to maturity, which most people don't, especially on something like a 20-year, but short-term T-bills, you know, you're getting really, really good yields right now. Okay. And, you know, some of these longer term bond ETFs, you know, if you want to get into those and you want to have a hedge where, hey, if the Fed does cut rates and something's really going bad in the economy and it's possible we have this recession or something, then I know that at least my bond portfolio should at least do good in a environment where the Fed is cutting rates, where potentially stocks have the potential to not really be doing well. Now, look at the 1 month change in sector-wide short interest. This is financials right here. And we're seeing a huge amount of short covering, okay, in financials. And I was really trying to figure out why financials were rallying so much. You know, in a couple videos ago, we went over a lot of the, you know, financials of the country, all right, of the US, talked about their interest payments and different things like that. And we were saying how, like, you know, what is the market telling you? Well, the market's saying it doesn't care, right? It was breaking out, right? You take a look here. We had the lows, we had a strong push up, an ABC up right here. And, you know, you could even try to call this a little bit of an inverse head and shoulders right here. But ultimately, that was a false breakout, right? We were trying to figure out why are financials breaking out right now when a lot of this data doesn't seem good. And the answer to that was the massive amount of short covering, right? So you can see communication services, you know, short interest going high, right? You know, going up right here. And you know, again, you're seeing, you know, financials drop right here, and that explains now why we were seeing financials rally, and makes a lot of sense. And clearly this was a false breakout to the upside, a textbook look above and fail, and this is pretty bearish, right? Indicative that we could potentially head lower. And financials, and there's another sector that I'm paying attention to right now. I can't remember which one it is, if I'm just being honest. But if these two sectors break down, to me, it's going to, you know, potentially mean a lot worse for the stock market and other things like that. So watching financials a lot right now. Now, one trend that has emerged in September has been the buying of energy, an area where net exposure sat at multi-year lows entering the month. And we kind of talked about energy already, but, you know, we're seeing a lot of short covering in financials, and it's very possible that a lot of that money is flowing into energy. Okay, when you take a look at the long activity trend, that's what this green line is right here. You can see it's been in a downtrend since May, and here in September we're seeing a sharp uptick. Okay, basically about 5 basis points in the long activity. This is the net exposure as a total percentage of total net exposure. All right. And, you know, again, just kind of highlighting, you know, some of the changes that we're seeing in energy. And, you know, we already talked about the charts, how they look really good. We talked about how, you know, oil could be potentially going higher. One thing to always keep in mind is when the trade when the trade starts to become a little bit too crowded, okay, and now everybody's talking about energy. Now everybody's saying oil prices are going to break higher. You know, those people weren't there when crude oil was at 60 bucks, 70 bucks. You know, they were saying that it's going to continue going lower. So now that it's really close to 100, you know, it may not be the best time necessarily to get in. You know, if you're not already in, the risk to reward ratio necessarily isn't as favorable at this point, but it's something to definitely continue to monitor and just, you know, keep an eye on. Hedge funds have been shorting consumer cyclicals in September. So September is typically the worst month in the stock market, right? It has very bad seasonality. And I've been mentioning since August, really, that it's the second half of September where you typically see the most pain. And boy, it's been a pretty brutal second half of September so far already. But when you take a look at the short activity trend in consumer retail, in leisure travel right here, in airlines, okay, and in U.S. housing, you're seeing really since August, okay, August was around the lows for all of these, and short interest has just been piling on, except for in airlines, right? Short interest has really started piling on since the middle of June. Okay, so keep in mind the potential for short squeezes. Okay, if something in some type of narrative changes in the market and we see a dramatic drop in the short interest and short activity, you know, you could see some potential squeezes in the market. Now, we said we were going to talk about some individual stocks. Okay, Palantir is one of them. You know, the setup right now is very clear for a head and shoulders, right? We've got our you know, left shoulder right here. We've got our head, We've got our right shoulder right here. These purple lines right here, these aren't actually moving averages. What these are anchored VWAPs. And so I've got them anchored to the earnings, right? So here's its earnings 3 earnings ago. Here's the anchor to the earnings 2 earnings ago. And, here is the anchor really to the all-time highs. I'm sorry, not all-time highs, but this cycle highs right here. And then we have the last anchor here, of course, to the most recent earnings. So basically what you're seeing is that from basically the past 2 earnings and the current cycle highs, your average trader is underwater right now. Okay, all 3 of those are underwater. And really the only one that we're trading above right now is the earnings, its initial earnings back in February. Okay, so lots of support to be built around here, but essentially this is the neckline, this white line right here for our head and shoulders. And it's very possible that Palantir could do something like this and head down to the 1224 area, potentially even lower to about $10.35. Now, if it does happen to break $10.35, there is a gap fill down here, okay, right around $8 on Palantir. These gaps, they do tend to fill about 90% of the time, but we're pretty far away from the gap right now. So a lot has to go right or wrong, depending on what side of the trade you're on, for that gap to fill. Now, I do want to mention that basically, I've been waiting for the next time to get into Palantir very patiently. And the reason being is because I'm tracking a 5-wave structure to the upside, taking it up here to the $23, $24 price region. Okay, that's what these numbers are on the chart. You have a 1, 2, 3, 4. All right, and which that's the one that we're in right now. We're currently in wave 4, and we're not magicians here. We can't, know exactly where wave 4 is going to end, but typically your wave 4 and your wave 2s, those should be an ABC correction. And you can see, we've got the A wave down, we got a B wave retracement, and it appears we're starting our C wave here. Okay. And C wave, if, we break through basically, support in the neckline here of the head and shoulders, again, can take us to 1224 or 1035. Is going to be some of the C wave targets. 1035, of course, would complete the head and shoulders. All right. And it's very possible that Palantir could come down there, but it doesn't have to go this low. Okay. Wave 4 could find some support and then start the next wave 5. Again, heading back up to that $23 to $24 area is really where I'm tracking wave 5 to end for Palantir after, it completes this wave 4, once it completes this wave 4. Now, this is XHB. All right, this is your Homebuilders ETF. This is actually another one that I put out in the newsletter. If you haven't noticed, basically the stuff I put out in the newsletter tends to be different from YouTube. Okay. I try to keep the content unique that I put out on YouTube, as well as the content that I put out on the newsletter unique as well. And we were shorting this one up here. Okay. Now I did close those positions very early, all right, because it had a massive sell-off in these 2 days. Took some profits, and if I would have held on to that play, I probably would have chickened out or ended up selling somewhere up here out of fear of losing profits, just for it to come down and make new lows. But essentially we have this bump and run pattern right here. Real estate, the home builders, is a very interest rate sensitive environment. And obviously Powell came out and was very hawkish, so it's no surprise. 77.13 is that big support level. If it stays below there, okay, it's very possible we're going to come and break through the second trend line. And the next big support level is 72.97, right? Just very textbook, old resistance potentially can become new support. So I wouldn't be surprised if it finds support at 72.97 or somewhere near there and starts to rally back up again. But ultimately, if we break through that level, then we're going to get this bump and run pattern to play out. Okay, here's your initial uptrend. Here's the bump up in price, and a bump and run is going to look something like this. And that has the potential to take it all the way down from $65 to like $55. Now, that's a pretty bearish and, more of a worst case scenario, but it's definitely something to monitor and see how it progresses after, the first leg of this bump and run is basically already playing out. As we mentioned, we are going to talk about gold today, so let's get into it with gold. Gold, I haven't gone long gold again, okay, or silver or anything at the moment, but I do still like it, okay? It's following the analysis pretty well, okay? The only thing for me is I'm just wondering if this C wave, all right, is completed or not. Okay. Essentially for the gold futures, a break below 1918 would be something that I'm looking for. And 1877, all right, is going to be the next big level of support. Ultimately, if we break below 1877 on the futures and we flip that to resistance from support, then that's when I'm going to be pretty bearish. Okay. And that's hence the bearish below. Right now, this is all healthy retracement territory after completing a bullish 5-wave up, right? I have 1, 2, 3, 4, 5, right? And we came up exactly to the wave 5 targets here, right? And we knew that this was going to be an area to sell at. I'll explain why very briefly. Okay. So you can see old resistance, old supply, old resistance, old supply. Again, resistance supply right here, but we also had bearish divergence. So let me go ahead and highlight that for you guys. See how price action is making higher highs right here. The RSI is making lower highs right here. That's a very simple bearish divergence. You have bearish divergence combined with overhead supply. It makes sense for a pullback and lots of profit taking at this point, which is what we did. Now, at that point, we're looking for the ABC correction to the downside. And as I mentioned, it's very possible that the C wave, is done, that, maybe this was an ABC here, and now it's trying to start its rally back to the upside. But I'd rather be safe than sorry. And, if we can break through a trend line, and get some type of a breakout here, then potentially I'll look for continued momentum. All right, I kind of drew something out here on the RSI that we're looking for. This is a weekly chart, by the way, but essentially we're going to be looking for a break of that bullish divergence, okay, and a breakout retest of that. That's going to show momentum, and that's going to show strength, and that's going to potentially take us out past these highs, okay? I like triple tops a lot. The reason being is 1, 2, 3, right? Triple top, okay? Basically it makes it easier for a breakout to the upside, right? The possibility of a quad top does form, but these sell orders here, these sell orders here, these sell orders here, they've all been filled. So the big question now is there going to be more sell orders replacing these sell orders? And is there still enough sell orders in here to create a supply imbalance and continue pushing price lower, especially after the 3 times that we've already absorbed a lot of the sell orders? Okay. If not, if those orders aren't being replaced and, a significant amount of that overhead supply has been absorbed, then it's very possible to get a breakout and retest and create a demand imbalance now, where there's an imbalance of buy orders and imbalance of demand pushing price higher out of the zone. That's what I'll be looking for. This is GDX. Okay, very similar chart. This is your gold miners. Again, just to kind of highlight, we're looking to see if we can potentially get a breakout here. Okay, GDX doing a very good job holding above 2714. Ultimately, for me, I would say 2714 is that line in the sand for GDX. All right, if we break below there, there's a gap down to fill right here on the daily time frame. This is a weekly chart right here. But we're going to be looking and seeing, if we can stay above 2714, it's very possible we get the breakout here. Okay. I mentioned on the gold chart, you essentially want to look for a breakout of trend, right? And there's a nice gap up to fill on GDX right around $36, above $36. So I think that would be a reasonable target. Okay. We were looking for it to actually fill this gap up here, on its most recent rally, on its 5-wave move to the upside, but it wasn't able to get high enough, right? It didn't have enough momentum, enough steam, and oftentimes gaps can also be areas of support or resistance. We can see that sellers actually stepped in here and pushed price lower. So here, you can see a little bit more of a defined ABC, right? A down, B up, C is actually a lower low versus over here. Things are a little more tricky, right? You have the A, B, and it seems like we put in. It's hard to say if we put in a C wave because we haven't made a new low here. We haven't taken out the wave A lows, unless you want to say that this is your ABC, a much smaller right here, A, B, and then C, and then those are the new lows. And again, this is us trying to start a new bullish count. As I mentioned, it's better to be safe than sorry. And, you can have some patience here. Don't have to force a trade. One of the things I do like about gold right now is that typically it moves inverse of the US dollar. And so here's what I mean by that, okay? We have gold futures here in white. We have Dixie, the US dollar index here in orange. And, you can see typically as, that these are kind of inverses, right? Okay, this is in a downtrend right here, making lower highs. This is in an uptrend right here. Then you see that reverses. You see the gold starting an uptrend right here. You see the US dollar going in a downtrend. And basically what we've seen is we're seeing gold hold up while the dollar has been rallying here. Okay, if you take a look, the dollar is basically flat right here, but gold essentially has been making higher highs. So we're going to look to see, if gold can really hold up, and if the US dollar starts to pull back here, typically that's a little bit bullish for gold, and it could help be some of the fuel that we need to get that breakout to the upside. So essentially, that's pretty much going to wrap it up for everything that we've looked at. The only thing left we have to look at, of course, is TLT. So let's actually head on over to TradingView, and we're going to break down TLT and give you guys my thoughts. So TLT, all right, let's try to make some things very simple real quick before we go and dive too far into these charts. All right, we're going to go ahead and actually just remove all of these drawings, okay, and just throw on our simple Bollinger Bands here. And I want to go over a simple concept, obviously the Bollinger Bands. And so what happened here is TLT most recently started trading outside of its Bollinger Bands, okay, meaning that it's trading below the bottom Bollinger Band. Anytime that this has happened in the past, okay, if you look over here, it's been a pretty good buy signal, right? And we see TLT actually start to rally. We see over here, TLT start to rally, okay? You see over here, trading outside the bottom Bollinger Band, TLT start to rally. See over here, trading outside the bottom Bollinger Band, TLT start to rally, okay? And most recently, TLT trading outside the bottom Bollinger Band, and today was a nice rally in the price of TLT. Okay, so we're going to see if this can be, continued to the upside. There's a big, massive gap right here. Okay, essentially all the way up to, let's see what price this is. Basically about $93 is going to be the top of the gap fill. And, if the Bollinger Band trick wants to play out, it's very possible we continue and, head back up to that $93 price level. Okay, and that's just a simple trick you can use. Now, an indicator I like to look at. Another one, all right, is going to be your MACD. So let's go ahead and zoom in on the MACD real quick here, right? And this is something that, in my opinion, we need to be pretty cautious of, all right? I did actually go long yesterday because I know how the Bollinger Bands work, and I know how TLT has acted with the Bollinger Bands trading outside of the Bollinger Band. Went ahead and just closed those positions today for some quick profits, via options, trading options, okay? The thing we need to be cautious of is we need to take a look at what's happened each time we've gotten a bearish MACD crossover. Okay, so here, bearish MACD crossover, right? I'm trying to draw vertical lines as best as I can. Here, bearish MACD crossover. Here, bearish MACD crossover. Okay, here, bearish MACD crossover. And here, most recently, again, you got a bearish MACD crossover. Now, some of those has resulted in very significant drops. Okay, you take a look at the huge drop here. Some of them haven't really resulted in big drops, right away, but ultimately ended up leading into a bigger drop, right? If you take a look right here, you can see we continued that downtrend, and then we started to rally back up, and then boom, we got the big drop. Okay, same thing kind of over here, right? We see where, we kind of continue this downtrend, have a pretty significant drop, and then we rally, actually cross back up above the middle Bollinger Band right here, or not the Bollinger Band, but the MACD, and then we get the real bearish crossover right here, and again, you can see pretty significant drop to the downside, right? So that's what we need to be cautious of right now, and that's kind of something that's got me, not really rushing right now. Okay, you don't have to try to time the bottom. Oftentimes it's better to look for some signs of strength and confirmation, and building a base. So that's what I'm doing right now, is looking to see, can TLT build a base here, okay, and potentially start to rally to the upside, right? But right now this MACD is, kind of scaring me a little bit, okay, because I've seen what it's done in the past. Been using the daily MACD on TLT as a really good buy and sell indicator for swing trading for a long time, okay, for almost 2 years now, and it's been working really, really well, and you can get some really nice, gains if you trade options, especially. Right, so that's kind of the stuff I wanted to go over, with you guys on some of the basics, right? The last thing actually that I want to go over with you guys is going to be bullish divergence. Okay, so take a look how we have a low right here, we have a low right here, we have a higher low right here. So we have actually continuing to make higher lows, right? The RSI is in an uptrend right here, making higher lows. Well, let's look at the same exact points on the chart. We have a low here, we have a lower low here, and we have a lower low here yet again. So we're seeing, lower lows on the price action. We're seeing bullish divergence here on the RSI, making higher lows. Again, this is an indicator you may see some type of bullish activity. You combine that with the fact that we're trading outside of the Bollinger Band, and it made a lot of sense, from a risk to reward standpoint, to look for, some type of a reversal in TLT and look for some type of green action. Again, I kind of wimped out on those, potentially sold them early, but I explained the risks and some of the things of concern that I'm seeing here as well on some of these different indicators. Okay. So I really just wanted to break those things down very simply, before we actually come in here and look at some of the levels, okay, and break down the levels and get, a little bit more complicated and things like that. Okay, so from a level standpoint, right, these are going to be our levels that we have. All right, the levels that I'm paying attention to right now, that are important to me. And these are going to be, let me zoom out a little bit, 91.03. So right now it's going to be an area of support potentially. Okay, 91.03. And below there, it's going to be 89.29. So as I mentioned, originally looking for, wave 1 down, 2 up, 3 down, 4 up, and 5 down. And it's very possible we reached our wave 5 targets here at the 1.41 extension, but I wouldn't be surprised if it comes down to 89.21, or it comes down below here and looks to find the bottom somewhere in between. Again, not really rushing. Now, the power of analysis, it can be very strong and very powerful if you're patient. Okay. And the reason I say that is because when TLT started rallying over here, okay, and yes, this was good trading opportunities, and I've been trading TLT all throughout this. But when it comes to the longer term positions, we had this huge, massive gap down on TLT, and this is something that I really wanted to wait for this to fill before I felt comfortable, going long for some long term positions, right? And so I started going long on TLT around 94.74. Because I wanted to get my feet wet. Okay. I wanted to get a position in TLT. And this is more of a, multi-year play. Okay. When it comes to TLT and buying in there at that 94 region. Now, of course, right now we're a couple dollars lower. So, those positions are down, but not really worried about them. Because again, they're more of long term, and I can now start to lower my average cost. And the big thing now is, where is this wave 5 going to end? Okay, that's really what I'm looking at now. And if we break through 89.21, I had an original target here of 86.47, potentially for this wave 5 down back at the October lows. We wanted to see how far that was going to go down. So it's very possible that if we break through 89.21, we head to the $86, $87 price range. But this means that Treasury yields are going to be continuing breaking out and continuing this really big rally. And so that's the big question ultimately that you have to ask yourself is, do you mind sitting through some of the day-to-day and shorter term volatility of things like TLT if ultimately you think that Treasury yields are peaking and, going to start flatlining and eventually start dropping? Then, I really wouldn't be so worried, right? And, it's really just a matter of time and letting time play itself out and waiting on the Fed to cut rates whenever that may be, whether it's 6 months from now, whether it's a year from now, 18 months now, or 2 years from now. We can't determine, right? And you don't want to put yourself necessarily on such a time constraint, by going into, leveraged funds like TMF. There is lots of decay associated with leveraged funds. Okay, and that's something that's not suitable for all investors, right? Is, I know people that got into TMF up here, and now they're really panicking down here, and you don't want that to be you. All right, so just keep in mind some of the risks associated with investing, and especially investing in bonds. Understand how they work, how they move according to yields, what drives yields higher, what drive yields lower. These are some of the bigger questions that you want to ask yourself. And hopefully you enjoyed today's video. I know it was a little bit longer. I've just been really busy with life a lot lately. I got 4 kids, a newborn. Okay, got to take them to school, got to do all this stuff. And then of course trading and being in the Discord rooms and day-to-day life and errands. So I'm trying to do better at pumping out the content. I put together a lot of content, and then it's hard for me to actually find the time to record sometimes. I got the new Madden, all right, and been playing the new Madden. All right, that's been pretty fun. That's been taking up some of my time as well here. Okay, so stay tuned for the next video. I've already got the slides. I've already got the data and analysis for that one. It's going to be really good, and I'm going to try to put that one out soon, potentially even tomorrow morning, or maybe just tomorrow night for the next, TLT and stock market economic data video.